Okay, so in this video, we're going to be doing IAS38. Now, you might be thinking, what is IAS38? This whole intangible assets. So, in our financial statements, we have assets, right? But below it, we can have something called an intangible asset. Now, you might be thinking, what is an intangible asset? It's basically an asset which you can't touch, right? But it is an asset because it meets the recognition and definition of an asset. So, whenever you have something that you can't see that basically gives asset to a business, you can recognize it in your financial statements. Now, I might be wondering, Yasin, tell me something. Is aura an asset? So, you will be given this, and you need to understand what's a asset definition. And basically, just how you have a definition and recognition for an asset, you have an asset recognition definition for an intangible asset. So, if you meet the full criteria, you can actually see whether it's a intangible asset. So is aura an intangible asset? Well, we'll see just now. Right? Now, going on, right? Now, there's a difference between PPE and intangible assets. Now, I might be thinking, why? PPE is something you can touch. Property, plants, and equipment. That's what PPE stands for. So these are your buildings, your cars, machines used in production. You can touch it. If I say I want to touch a machine, I can do it. That is PPE. However, intangible assets, right? Intangible assets is something you can't see. So these are something like, example, a patent, copyright. You can't see these things. You cannot touch it. You can't wake up one day out from a bed and say you want to touch a patent. That's not going to work, right? Now, what's the definition of an intangible asset? Now, you will break this definition up to prove an intangible asset. So know this definition by heart. Now, what is this definition? An intangible asset is an identifiable non-monetary asset with no physical substance. Now, you might see that and be like, what is this identifiable? What is non-monetary? I'll explain. So when they say an intangible asset is an identifiable thing, identifiable means two things. And in the next slide, it actually says what it is. Yeah. So, wait, it says somewhere. Yeah, there you go. So what does identifiable mean? Now, should I start over here? I'll start over here. Oh, wait, we'll go to back. Yeah, I think it's better. Yeah, just let me go back. But basically, identifiable means two things. It can be separate, or it can arise from contracts or something. But we'll see that just now. If this thing stops working, man, come on. Let's just go back to a definition. I'll go to that just now. So, intangible asset is a identifiable non-monetary. Now, non-monetary means it's not like money. Now, what I mean by that is, for example, if you buy something for cash, a machine for cash, you buy the business cash machine, you get the machine. However, this intangible assets, obviously you can't see it, so it's like it's non-monetary in a way. Like you can't like physically see it. So that is why non-monetary. And with no physical substance, so obviously you can't touch it, right? Now, examples of intangible assets, you got patents, copyright, and trademarks. Now, patents, if you own a patent, you can basically only manufacture the product. For example, if you invented the fidget spinner, and if that person who invented the fidget spinner made a patent, that person only could manufacture fidget spinners. But obviously, that never happened. Copyright, if you own like a CD, DVD, music, it's copyrighted, meaning you cannot use it. So I can't put it in my video, for example. Trademark, what represents a brand, so like Nike, all those stuff, that's trademarks. Now, intangible assets may be acquired into two ways, right? Number one, you can either exchange the asset, or number two, you can buy it, right? Normal buy. 100,000 Rand is the intangible asset. I buy it, that's normal. And then obviously acquire it by exchange of assets, right? If I have a phone for 10,000 Rand, for example, and the intangible asset is 15,000 Rand, I will give my phone, which is worth, what I said, 10,000. 10,000. That will be what I'll record my intangible assets for. We'll come to that where you'll see when you exchange assets which price you must actually put in your books. But basically, when you exchange assets, you can do that also. Right? All those two is not examinable, so you don't have to worry about that. Intangible asset. Okay, here's the thing, right? So earlier on where I said the definition an intangible asset is a identifiable. Now, an identifiable, we got confused over there, but now it's telling you what identifiable means. It means two things, right? Identifiable means it's separable. Now, I might be thinking, what's separable? Separable means it has a life, it has a body, it has freedom. So, what this means? It basically means it can be separated from the owner. For example, right, if I have, let's see, well, if I have a copyright, I can sell that copyright to someone else. It's separable. It can be separated from my business. If I have, let's say, a machine in my business, that's separable because I can sell it to another business, and that business can own the machine. That's separable. It can be separated from the business. But what can't be separated by a business is not separable. For example, internal goodwill. Now, what's internal goodwill? It's goodwill for a particular business. For example, if a business name is uh, uh, a monkey food where they sell monkey. Basically, this business is in UKZN and they take all the monkeys and make some nice soup with it. Hey, soup is nice and cold. Anyway, not the point. Point is, if they have a goodwill, internal goodwill, it's only for their business. That goodwill was created for only their business. So this goodwill, you can't sell it to other businesses. It only belongs to your business legally, and it can only be in your business. So you can't make it into another business, transfer it to another business, sell it to another business. That's what separable means. I mean, that's what non-separable. So separable means you can transfer it to another business. Okay. Uh, Arises from contractual or legal rights. Now, it means you bought it. For example, if you bought it, right, most likely you're gonna be contractual rights if you bought it. For example, if I bought an intangible asset, I buy it and I get a receipt or whatever. That is like a contract, right? It's a contract. Legal rights. So let's say if you bought a copyright from a person, you have the legal rights to produce music or songs from that artist, right? That's legal rights. Now, earlier on where I was saying whether aura is an intangible asset, let's see if it actually meets the definition of an intangible asset. So, aura, right? Is aura separable? Can you sell aura to another person? No. Why? Because aura belongs to you. When you create that aura around you, that atmosphere of auristic, by the way, I made a new word. Whoever has an aura and like has an atmosphere, I say aurastic. Aurastic. Aurastic is a new word I made. I patent it right now so nobody can copy it, right? So aurastic. Now basically auristic is wait, what I'm speaking? Aura. So aura, it doesn't meet this definition, it's separable. You can't give aura to another person. You can't. Aura belongs to you. So you see how it cancels this. So it doesn't meet this definition. So as soon as it doesn't meet this definition, we know it's not an intangible asset. But let's go further and see if it meets the second definition just for fun. It arises from contractual or legal rights. Did I buy aura? Did somebody give me legal rights to have aura? No. Or you get aura just like that. Click of a finger, you get aura. If you, I mean, that person who just gets aura just like that, you never get it from buying it. You never getting it from somebody transferring it to you. You didn't. So because that, it basically it's none. So it's not this one, not this one. So that's why aura cannot be treated as an intangible asset, right? So in your exam, right, when you want to prove intangible assets, you have to prove three things: meet the definition of an intangible asset, meet the asset definition of an intangible asset, meet the recognition of an asset. Remember, proving intangible asset, there's three things, right? So this you're proving that it's the definition, meets the definition, right? This definition of an intangible asset, it's not this or two, it's the ones in the beginning. You know where I said the definition of an intangible asset, it's a what's intangible asset is a it's a separable non-monetary asset that has no physical substance. So you break that up, right? So you prove that it's identifiable by doing this. Then you prove that like it's non-monetary. Then you prove that it's has no physical substance, right? Yeah. I'm just going to, so when you're looking at this video, just go to the comment section and see what monetary means. I don't think I explained it properly what monetary means, because you had also tell like the asset has monetary. So I don't think I explained what monetary is. I need to research it. So by the time I upload this video, it'll be in the comment section. So you must look at that. Right? Okay, so money spent on advertising, is it an intangible asset, right? No. Why? There we go. It breaks separable. It's not identifiable. Why? Because when it's identifiable, it must be separable. But it's not separable. If you have an advertising contract in a business, right? You advertising on your business, your own business, can you transfer this advertising to another business? No. You pay 10,000 for advertising your business. You have to put 10,000 as an expense. You can't represent it as an asset because it's only for your business, you see? And obviously, it does not arise from contractual or legal rights. You never buy advertising. Like, you never get like a business deal. Like, let me give you advertising. No. Yeah. So I told you must meet the intangible asset definition. Then also must meet the asset definition. Now, asset definition is this, right? You know this. Then you must meet the recognition criteria. This is the same as an asset. And then after that meets those three things, it's done. It's an intangible asset, right? So don't forget that. Yeah, so these are all the critical things we just discussed and so on. Now, without physical substance, int has no physical substance. Yeah, it's something you can't touch. Now, what happens if an asset is intangible and tangible at the same time? So now you have to pick, right? A fishing license is an example of one of them. A fishing license is a physical form you can touch, but at the same time, it's like intangible because like it's a law that you got now that you can fish. Or car license. A car license, you have a license, but also it allows you for driving. So it's intangible and tangible at the same time. So now, according to IAS38, you have to choose which one, right? You choose the one that is most better. So if you think about it, for example, for a fishing license, right? Yes, it's tangible, you can touch the fishing license, but it's more of intangible. Now, I might be thinking, why is it more of intangible? It's more of intangible because it allows you to fish. It doesn't give you something like physical. For example, a machine in my business is tangible, it's physical. I can get products out from the machine. But a license, can you like think about it? You can't like put products in, get products out of a license. It's more intangible. It's a rule that allows you now to drive. It's a rule that allows you to go fishing. It's a rule that you cannot see, so that overpowers the tangible of that asset. Therefore, it's an intangible asset. Anything, all licenses are intangible. Remember, fishing license might come out in an exam. Did they use it? Common. So, although a physical license has a physical form, okay, the license is considered an intangible asset rather than a tangible asset, and it's an ability to fish. See, it's like a law it gives. So it's not like something that you can touch, see, or whatever. Right? Okay, so when you have an intangible asset, right, and when you purchase it, now not exchange of assets, when you purchase it, acquire it, how would you record the cost in your books? So it's the purchase. So this is like normal, how you record inventory, how you record normal thing. It's your cost, which is your purchase price, obviously, plus your import duties. So whatever cost that incurred to get the item in your shop, right? Everything, minus discounts, minus thing. Mostly they'll do is like they'll say carriage, which is delivery. You have to add it to the cost. They'll say you paid people to put it in your shop. That deals with the installation, so you have to record it, right? They'll give you a trick question there. They say after the product is installed, you got a person to paint the machine. That you won't add it to the cost, or to advertise, you won't add it to the cost because that's not bringing the product into installation. That's after installation, you don't add cost there. Legal fees, all that, right? Testing fees and so on, all are capitalized. How you will capitalize each cost? If they tell you the cost for the import duties is 100,000, the way you'll record that is debit intangible assets, credit bank, right? So that's how you add all these to the cost, right? Yeah, cost of employees. So as I told you, anything arises from bringing the asset into the working condition, right? You add. So cost of employee if you brought it into working condition, cost of testing, because you can't put it into working condition without testing, huh? Intangible assets. These costs can be introduced in more never be capitalized. Advertising and so on, right? You can't capitalize it. Now, example. So all these are just yapping, but I'll come to these answers. Okay. So purchase of copyright, right? Do you add the cost of this? So this example is basically saying that what do you add as a cost? Purchasing of the copyright, obviously that will be the cost, so you'll add that, right? Just note, right, in this example here, they said this includes VAT. So all the amounts including VAT, you have to take out the VAT. It must be exclusive of VAT. Always exclusive of VAT when you're recording the cost. Don't include the VAT. So obviously that's how they did it, right? So they took out the VAT from this to make that. Purchase of copyright will be added to the cost. Legal fees, yes, because it brought you into the condition. That's a legal fee. Studio fees, no. Operating, no. Marketing campaign, no. Why? Studio fees has nothing got to do with the product being into installation into its form. Advertising too, nothing. So only legal fees and copyright, because that's only the cost that needs to be added, because that brings the product into installation. Now, very important, extremely important, will come out most probably, amortization. Now, when we're dealing with intangible assets, right, we don't call depreciation. We call it amortization. Now, when we amortizationing, is that even a word, amortizationing? When you amortizationing an asset, right, there's a couple of things you need to like consider. Because like when we do depreciation, for example, you need to know whether it's straight line or diminishing balance method. You need to know what is the economic lifespan, so you know how many years each year depreciation for. You need to know like what things. So there's different things you need to know. Same for amortization, right? You need to know a couple things. So obviously amortization is a systematic allocation of the depreciable amount of intangible asset over its economic useful life, right? Now, question, it's very important. Intangible assets that have an unlimited useful life are not amortization. Okay, so example, if something will last forever, you can't depreciate it. Okay. A company purchases a patent. The company organizes lawyers for a payment of 1.1 million. Okay, so there's a patent that you're going to buy for 1.1 million in a year's time, right? Now, important, they say this is not normal credit terms. So whenever they say this is not normal credit terms, you have to use the present value formula when recording in the books now. So because 1.1 million is paid 1 year in the future, today when you record it in the books, it will be a different amount. It's called the present value formula. PV is equals to the future value over 1 plus I, all in the brackets to the power of n. So basically, it will be, to work out the present value of this amount, it will be 1.1 million over, open brackets, 1 plus 10% close bracket to the power of, is it 1 year? 1 year. And that should give you 1.1 million, right? They did this calculation also, same thing. Would this answer change if we consider it to be normal terms? If they said normal terms, you use this value. The reason why we use present value is because they're saying this is not normal terms. So they're saying it's in normal terms, then you use the value over here, right? Now initial recognition. Okay, now we said when you buy something, the intangible asset, you obviously have to pay for costs, the inventory, the carriage, the delivery, all that. That's how you call the cost. But what if you're an exchange an asset, right? So if you're an exchange the asset, how do you recognize the cost of it, right? Because you're exchanging the assets. So very, very easy. So I'm going to put an example. Let's say I have a phone for 10 Rand and an intangible asset is 100 Rand. So I'm explaining this very, very simply in simple numbers so you understand. Phone is 10 Rand, the intangible asset is 100 Rand. Now I'm exchanging the two. What do I record in the books of my intangible asset? Number one, you record the cost as a fair value, right? Cost is fair value, so it's the same thing. But the first thing you look at, the most important thing you look at, the fair value of the asset given up. So in my books, I'll record it as 10 Rand intangible asset. because my phone is worth 10 rand, the intangible asset was worth 100 rand. But they're saying here, you measure it first as a fair value of the asset given up. That is why in the books it'll be 10 rand. Now, if you don't have this, you don't have the fair value of the cell phone, of the thing you're giving up. You go to the next one, the fair value of the other thing you're exchanging, which is the intangible asset. So if I never have this fair value of my phone, I'll use the fair value of the intangible asset, which is 100 rand. If you don't have those two, then you go over here. It's the carrying amount of the asset given up. So the carrying amount of my phone. But you see, if they don't give you this, you go with the second one. If they don't give you the second one, you go with the third one. But you start from the top, right? So let's see an example. If an asset pays cash for an asset and the customer is retaining pass. Let's see. Yeah. So when an asset is purchased beyond normal terms, credit term, it does its present value. I told you this. We did before this. I told you. Same example we did before, right? So so you know how I said when you record it in your books, you record it as 1 million. This was the formula. But obviously the difference is 100,000. So you still have to record the 100,000. But on this date here, you don't have to record the interest. You record the interest over here. The journal entry will be debit interest expense. Sorry, no, wait. Interest expense, cost of buying, interest expense. Or you will. Debit interest expense, credit bank. Yeah. Now, okay, let's read. So Duke Business currently has a Samsung cell phone that he wants to sell. Sandy approached Duke, but Duke shared no cash, but could offer a patent. So Sandy has a patent, Duke has a cell phone. Now, the fair value of the cell phone is 2,000 rand, right? And the fair value of the patent is 3,000. So which one is you going to pick? Well, we're going to record the intangible asset which she's going to give as 2,000 because we have the fair value of the phone we're giving up. So let's see if that is right. There we go. The fair value of the phone is 2,000, so we can record that. Over here, the fair value of the S3 is not evident. So we don't have the fair value of this phone we're giving up. Then we must use the intangible asset fair value, which is 3,000. If we have neither one of them, if neither fair value is evident, the intangible asset you don't know, the asset you're giving up you don't know, use the carrying value of the thing you're giving up. So cell phone carrying value, 1.5, yeah. Yeah, 1.5. Now research and development. Now research is not an intangible asset. Never will it be. Research is not, right? This whole thing is saying that research is not an intangible asset because it probably will not. It's a very low probable chance that you're going to have inflows, right? Because a research, it doesn't have to produce economic benefits, so you can't recognize it. So research never an intangible asset. It will be an expense. It won't even be an asset, it'll be an expense. Now development, however, will be regarded as an intangible asset, huh? Because development takes place when you know for sure something will give you economic benefits, right? But obviously development, for you to record as intangible asset, it has its own definition, or not definition, recognition. So basically it has to meet all this stuff over here for you to recognize it as an intangible asset, you see? Quite a bit of stuff, to be honest. I don't think they'll test it because there's so much. But again, they could test it, so learn it. I just want to see development expenditure capitalized the following criteria. Yeah, it's capitalized as an intangible asset. Oh no, sorry. What I mean by development, let's say we have an intangible asset. Development will be capitalized to that account. If you have development, right? Yeah. Okay. So new material. Okay, fine. Now internally generated IA. Now what is IA? It's internal goodwill. So internal goodwill, let's see. Do not capitalize internal generated goodwill. Treat it as an expense. Why? Internal goodwill does not meet the asset definition of an intangible asset because it's not separable. It belongs to only one business. All these you don't capitalize, right? You don't capitalize. You don't capitalize. Yeah. So because the cost cannot be separated of the overall expenses to cost of training cost. So basically, all this can't be capitalized. Huh? Subsequent costs. So any cost that let's see, capitalized subsequent costs is unusable. So if costs related to example the intangible asset, right, occurs if the cost meets the so if the cost meets the definition of an intangible asset, you can capitalize it. For example, I tell you development, it will meet the intangible asset definition, so you add it to the cost, right? So if you do development of an intangible asset, you add it to the cost. uh, Purchase goodwill. So purchase goodwill is recognized as an asset in the books, not an intangible asset, and as not identifiable. So I told you, goodwill can't be separable, so it cannot be regarded as an intangible asset, right? But it'll be regarded as a normal asset. It's a normal asset. Now, know how to do this because it came out in a past paper. So basically, you're acquiring a business. Now, I might be thinking, what does it mean? I'm buying a whole business, right? Very, very simple technique y'all use. Very simple technique. First, A. So A is the first thing, like what happened. So you need to record the journal entries. The fair value of the patent, which is this, is reliably measured at 100,000. So that just says the patent is measured at 100,000. So you're gonna pay 100,000 for the patents. Now, how do you record this journal entry? Well, they got everything over here. Literally everything's over here. I want you to think very carefully of this. You acquired this whole thing here for 700,000. This whole business. So straight away, credit bank 700,000. But you're also gonna credit liabilities. You'll debit patent. You'll debit PPE. If you do that, wait. I just want to see the answers here in case I don't do wrong. Yeah. So you do that, right? But now I might be thinking how I got 300,000 here. Simple. It's the goodwill. So right now, they're tricking you over here. They don't tell you the goodwill. You have to work it out. Goodwill is equals to assets minus liabilities of that business. You are acquiring this business over here. So you need to work with the assets minus liabilities in here. Assets. These two are assets. So 500 plus 100, 600,000. Minus liabilities, 400,000. So your goodwill is 400,000. So because goodwill is 400, wait, 600,000, 400,000. Wait, how are they getting? Oh, sorry, wait. First step of recording goodwill, find the net asset value of the business. Net asset value of the business is asset minus liabilities, so it's 400,000. But to get now the goodwill, it'll be what you bought it at minus it. So 700,000 minus 400,000 is 300,000. Why? You bought it more than the value, the net asset value of the business. You see? So it's 400,000 it's worth. But you paid 700,000. So 300,000 would be a goodwill. And goodwill is an asset you debit. So you debit goodwill. And guess what? Debits equal credits. Or if you never know that, obviously debit has to equal credit. So this would be the missing figure. But you debit PPE, you debit, yeah. So basically you'll debit this, you'll debit this, you'll credit this, you'll credit this amount, and the balancing figure has to be the goodwill, you see. But now if the future value patent not reliably measured at 1,000, and the carrying value. So I'm not gonna lie, I think this is a mistake over here because they have no patents over here. So I think it's a mistake, but at the same time I don't think it's a mistake. Future value of the patent is not reliably measured at 100,000 is a carrying value. But why they never, like, I genuinely not going to tell you anything because I feel like it's a mistake. But at the same time, I don't know why they did this. Well, if The patent, they don't have a future value but it has a carrying value. I assume you use a carrying value over here, but I don't know. I think it's a mistake. And for the third one, your purchase price was 3,000 Rand and all values are future value. So now instead of the 700,000, let's assume the purchase price is 300,000. So you're going to credit bank for 300,000 obviously. Your credit liability, same thing what you did before, same thing what you did before, debit this, debit this. The missing figure will be, but now it won't be goodwill. Why? Purchase price was 300,000 Rand, right? But let's work out what the net asset value is. The net asset value is 600, 500, 400, 400,000. So if the net asset value is 400,000, right? And you paid 300,000, you paid less than the net asset value. Goodwill only happens when you pay more than the net asset value. But here, the business is worth 400,000, but you paid less, 300,000. So what's this? This is profit. You're buying less than what it's worth. So when that happens, it's not goodwill. It's the opposite of goodwill. It's gain and bargain of purchase. Right? Done. Impairment is not examinable, so you don't have to worry about it. Intangible assets is measured in the cost and revaluation, but it's not an examinable revaluation. So cost model is only thing. Right. Now, last year's past papers before that, you had, and probably this paper that's coming up, we have to do an email for IAS37, right? Now, is this IAS38 or 37? Well, one of them, whatever it is, but basically, you have to write an email on amortization. In amortization, you have to discuss three things. The useful life is number one, the residual value is number two, and the period is number three. Then you're done. Sorry, method, period, and residual value. Those three, method, period, and residual value. Method, period, and residual value. Method, period. Period is useful life. That's the same thing, right? Yeah. Okay, so first let's do useful life, right? Useful life. Amortization is expense unless it relates to creation of another asset. Okay, so this is not an indefinite useful life. So wait, first of all, amortization you won't do. If an asset has indefinite useful life, it has an unlimited useful life, you don't do. You only do when it has a definite useful life, right? Okay, so let's discuss. There we go. Three variables. Residual value is number one. Let's discuss it, right? What is the residual value? The residual value, right? So here's it over here. Should now in your email when they tell you this, the first thing you say, residual value for intangible assets should always be zero unless. And you mention these 2 points. These two things come from this point, right? So if a third party has committed to buying the asset, so if there's somebody who wants to buy the asset, who told you at the end of the useful life he's going to buy the asset, you can record the residual value at what that person is going to buy it at. Now, another possible option, there's an active market for that asset. And it meets this definition. It must be possible that the measure the residual value using the market. So obviously if the market wants 100 Rand for the product, it must be that, huh? And it's probable that the market will still exist at the end of the useful life. When that happens, whatever the market value, residual value is, you can use the market value, residual value as that, right? So it won't be zero. So that's the thing must discuss when doing with residual value. So example, no third party has committed to purchasing, but there is no active market. So this is none because none requirements. Second one too is none because nothing. Third one over here, there's no third party, but it has an active market present and the probability will exist in 5 years' time. So then you'll use that, right? As 30,000. Yeah. For third party has committed to purchasing the asset by 10,000. So party I told you wants to commit buying the asset, so 10,000, right? Now period. So period. How will you determine the lifespan of an asset? Lifespan is same as period, right? It's very easy. You got two things. You got the expected useful life and you got legal life. So you got expected useful life and you got legal life. Two things. The one that is less, you pick that. I got expected useful life. I got legal life. If my legal life, which is less than my expected useful life, you pick legal life. For example, if your fishing license, right, It has an economic lifespan of 20 years, but it has a legal life of 5 years. You'll pick the 5 years as is the period of the lifespan of the asset. You see what I'm saying? So, also it's so let's read. It has a limit. Okay, so if an asset has a limited legal life, the economic useful life would be limited to the legal life if shorter. So basically, it means the legal life. It'll be a legal life if the legal life is shorter. Now, very important. Unless the legal rights are renewable and there's evidence that the entity will renew these rights, and renewing the rights will not be significant. So basically, if the asset right has a legal life less than that of its economic life, you pick that. But you won't pick the legal life if the legal rights are not renewable and there's not even evidence suggesting the entity will renew these rights and consider renewing the evidence. Okay, so it's a bit difficult to understand, but let's explain with an example. So the license can be renewed for 2 years at an insignificant cost, but the company is not planning to do so. So it has no intention of having this one legal life extended, because right now it's 3 years. If he has no intention to extend it for another 2 years to make it 5 years, we only record 3 years because he has no intention. The second one, the license can be renewed at 2 years at 1,500, and the company will be renewing the license. So here, it expects to renew it. He wants to renew it. He has intention. So he added 2 years to the 3 years. That's 5 years. The license can be renewed for 2 years at 140,000 rand. Now, one of the requirements means it mustn't have an insignificant cost. But here, the cost of renewing it's so much. You look over here, the comparison, it's too much. Over here, it wasn't too much. But over here, it's too much. So it'll still remain at the 3 years, right? Method. Method is the easiest. It's what type of amortization? It's straight line or diminishing, right? Or it can be units of production. And also, amortization I discussed. There won't be any amortization if it has a indefinite useful life, right? And yeah, that's it how you'll discuss that, right? Amortization. So three things: useful life. Wait, let's see, useful life, method. Yeah, so useful life, method, and residual value. Those three things you discuss. Period and useful life is the same thing. And yes, that's it for intangible assets IAS. Wait, what IAS is it? Let's see. 38, 38, 38, 38.